Hello, I'm Aaron Fronda, Managing Editor at The CFO. Welcome to the first episode of our Economist Insights series, where I'll be speaking with leading economists about the latest economic trends and challenges impacting businesses, with the aim of providing senior finance leaders with the necessary guidance they need to navigate their organisations accordingly. Today, I'm joined by Mohammed Chaudhri, Chief Economist and Director of Market Intelligence at Experian. In this session, we will explore the impact of rising inflation on the UK economy, how interest rate hikes will place further pressure on working capital, and what businesses can do to protect margins amid this challenging economic backdrop. Thank you for joining me today, Mohammed.
You're very welcome.
Thanks a lot. So I just want to sort of kick things off really with a bit of an overview of the state of the national economy amid rising inflation.
Yeah.
Obviously, last month in June, we saw UK inflation hit 9.1%, a 40-year record high, with the Bank of England forecasting inflation to top 11% later this year. So just to sort of start, I wondered if you could sort of outline how rising inflation is impacting the UK economy at both the consumer and business level.
Absolutely. And it wouldn't go without comment the fact that we are all living through the shared experience over the last few years with both the pandemic and, in very quick order, the cost of living crisis, with also the conflict in Europe coming in. So those three things I've mentioned really are once in a generation impacts, with the pandemic actually being one that you could say is 1 in 100 years worth of effect on the economy. So what's the impact? How is inflation in today's economy impacting customers, consumers, businesses that we're all part of? Let's take each of those in turn. So on the consumer, from the consumer's perspective, obviously the cost of living you mentioned there, and inflation is already above 9%. There's two real effects. And the first one is on what we would call real disposable incomes. All of us, most of us are paid through wages and salaries. That makes up the biggest contribution to our incomes. Some of us will have investments, others will maybe getting some from some form of benefits. But wages and salaries, for the biggest part of the UK working population, is the biggest source of income. With inflation going above 9%, what we're seeing is a real squeeze emerge. In fact, wages are falling at their fastest rate for over a decade. So the first impact is the pound in our pocket just isn't going to be buying as much. So then the effect that is having is twofold. The first is, for many of us, we are having to cut back on non-discretionary items or even discretionary items. So your non-discretionary items, your food spend, your energy, most of us would have to spend on that regardless of what our income and inflation is. But what we are seeing is, even in those non-discretionary items, people are having to make cutbacks. They're not turning on the heating. Now, that on a day like today in the summer, that's not a problem at all. But you forecast forward to the winter months, that's going to really be an issue for many households. On food spending, if I was to be able to show you a chart right now, I'd be showing you that as a population in the UK, we are spending less money on goods in the food sector. To put that into a real life example, we're buying less loaves of bread as a UK population, but each individual loaf of bread is going up. So we're spending more in money terms, in value terms, on our non-discretionary spend, but from a volume perspective, we're actually reducing that. Now that's going to have an effect on all types of businesses, consumer-facing businesses, B2B businesses. And when we move on to that angle from a moment, that means there's two real impacts from inflation on businesses. The first is a lack of demand, or a demand correction for many goods and services. Like I mentioned, households will be cutting back. The second is a squeeze on margins from a cost perspective. When we're talking about inflation, we're talking about the cost of raw materials going up, production going up, also wage costs going up. Many of us are going to be going back to our employers asking for higher rates of pay in order to keep up with that rate of inflation. So those are the real impacts that we should be looking out for. Consumers feeling less wealthy, therefore making cutbacks in what they're doing. From a business perspective, that feeds into a lower revenue number potentially, but also on the cost side, a squeeze coming through on that.
Okay. And so you obviously there you talked about obviously margins being squeezed even more extremely due to rising inflation. Obviously, given that inflation is set to increase further, as we mentioned before, what advice do you have for businesses on, how to budget and forecast over the next 12 months, obviously amid, headwinds like rising fuel and energy costs?
You hit the nail on the head. It's all about that forecasting capability. As a macroeconomist myself, as part of the Experian, we've moved away from just calling out a central forecast. Even if we go further back than the pandemic that I mentioned only a few minutes ago, you go back to 2016, the vote for Brexit, the referendum, the uncertainty that created. We saw then a real depreciation in sterling come through quite quickly. It was a similar effect on households where inflation went up above 3%, but it self-corrected itself very quickly. Now, the reason I go back that far is because at that point in time, we introduced scenario analysis for many of our forecasts. We felt just speaking to our audience, to our clients about a certain set of inflation numbers or one particular unemployment number, GDP number, cost number, was actually not as beneficial as setting out different paths of the economy. So how can businesses actually plan for the future? It's by looking at those different scenarios. What happens to your margin if the Ukrainian and Russian conflict becomes indefinite? What happens to global oil prices if that's the case? You're going to have to run that scenario through. Our central cases, hopefully things do start to self-correct. We do not see those elevated prices continue for a while. At the same time, what happens if we were to see a return of some of the lockdowns that were associated with the pandemic in China, for example, those supply constraints coming through? So as businesses plan for the future, we have to adopt a scenario planning mentality. Simply having one case that we are all reading off and planning for isn't going to be helpful. We're going to have to make sure that we run those scenarios before they emerge, because then and only then will we have the plans to actually enact and make sure that we can maintain those margins. So the first thing I would say, when you're forecasting numbers, we've mentioned a couple here in terms of inflation going above 11%. What happens to your margin if inflation is 14%? What happens to your margin if inflation is even higher than that? These have to enter the business planning cycles from now.
And sort of moving forward a little bit now to talk about interest rates. Obviously, the Bank of England has been criticised by some for not raising rates more aggressively to prevent a weak pound from fueling inflation even further, despite the bank raising rates to 1.25% last month. Obviously, based on inflationary forecasts, it is likely that the Bank of England will be forced to raise rates faster and more aggressively in the coming months. Could you explain how this will apply further pressure on working capital moving forward?
Yes, I can. And there's quite a lot to break down there. If we just go back to the Bank of England's reason for existing from a monetary policy perspective, an interest rate perspective, if you will, their mandate is very clear. They are to maintain price stability, and the government defines price stability as a 2% inflation rate. And whilst maintaining price stability, they should support the government's objectives for economic growth. So they have one, shall we say, key objective, inflation, but also a secondary objective around economic growth, which they must pay some attention to. The other thing, before I go into the working capital, is we have to understand, as a policymaking institution, the Bank of England's time horizons are around 2 to 5 years. Now, the reason I mention that is because the Bank of England, when they set interest rate policy and they are setting interest rate policy for the future, it takes nearly 2 years for an interest rate change to actually affect inflation. Now, in normal times, and I use the word normal to describe the last 15 years before the pandemic, if you will, a change in interest rates would take 18 months really before it would impact economic growth. From that perspective, in terms of making things a little bit more expensive from a capital perspective, making more things more expensive from a borrowing perspective, and then another 6 months before it affects inflation. So yes, the Bank of England has been criticised, no doubt about that, in terms of missing the ratcheting up of inflation to 9% and latterly over the last part of this year to over 11%. But we have to understand the Bank of England is now setting policy not on what inflation is today, on where it thinks inflation is going to be in that 18 to 24 month horizon, and to have an impact on that and really start to push down on that. You mentioned there the effect on working capital. Now, obviously, from an interest rate perspective, rates have gone up from 0.1 to 1.25. How can you hedge against that? How can you guard against those further ratcheting up of working capital? Obviously, funding markets remain liquid. We are still seeing quite strong issuance of corporate bonds, etc. From a smaller business, from an SME's perspective, locking into some of those more fixed rate products may also be beneficial. The one thing I would say is, from the Bank of England's perspective, what's next? What are those next steps in interest rates? We do expect interest rates to continue to increase until the end of this year. The one thing you have to keep an eye on is what's happening to inflation expectations. It's not just inflation going up to 9 or 11%. It's the expectations that all of us on this call as individuals, all of us as businesses, where do we think inflation is going? Do we really believe inflation is coming down next year? It's going to come down the year after, it's going to come down the year after. That is going to be crucial, because if those expectations become de-anchored, we no longer believe they're coming down. We think inflation is going to stay at 10%, for example, for the next year and the year after. The Bank of England would have to ratchet up interest rates. They will really have to push down on interest rates. And that's when we come back to our scenario planning. Have you planned for a world where that happens? Should you be able to stress test what's happening to your working capital calculations if that was to happen? Right now, inflation expectations have moved a little bit. It's a key variable for all of us to be paying attention to. If they were to continue to trend upwards, that's the reason why the Bank of England would increase interest rates faster. It's all to do with expectations. It's all to do with what's going to happen. They are paying close attention to inflation expectations. If inflation expectations continue to trend upwards, the Bank of England will have to take further action, quicker action, in terms of moving those expectations lower. If inflation expectations remain anchored, then the Bank of England could actually slow down on the pace of increase in interest rates by the end of this year.
Perfect. And to go back a little bit now, I mean, we talked at the top of the interview about kind of inflationary pressures having an impact on all businesses, but obviously B2C businesses will likely feel the impact of sustained inflationary pressures more acutely. How are consumers responding to current market conditions, and what actions should businesses take to prevent margin erosion?
I spend a lot of my time working with clients from the banking and financial services sector. No surprise to anybody who knows what Experian does, also with a lot of lenders. So the first thing that I will provide some insight on is the impact on the B2C market as lenders are lending to consumers, is one where we can, again, there could well be two impacts. The first impact, as people tighten their belts, and like we've mentioned, from a retail perspective, we're seeing this come through in retail sales. Retail sales volumes are lower than they were, although the values remain as high. So there's an interesting observation from a margin perspective. We are still seeing the same overall revenue numbers being coming in for retail sales, whilst the amount being spent on the actual good is lower. Inflationary impact, if you will, is evident in that in that statement. So back to the impact on the consumer. The consumers can either cut back or they can borrow more money in order to make those ends meet. Now that's really important. What is the behavioral effect going to be for households? Many households have built up excess savings over the last 2 years. During the pandemic, for example, many of us weren't able to go out and spend because of government restrictions. We weren't able to go to our restaurants, weren't able to go abroad, we weren't able to go out and go to the same leisure activities like we did before. That meant we built up savings above the norm. So households could use their savings and continue to spend as normal. So from a B2C perspective, it's about understanding what's happening to consumers. We know incomes are lower. We know inflation is higher. But you have to complete that picture. Are people running down their savings, or are they in fact going the other way? They see the economic storm clouds gathering. Are they now not only cutting back, but they're cutting back more than they need to from an income perspective, because they're also increasing their savings? As you normally find in a recession, households cut back and you see savings increase during periods of uncertainty. At the very same time, if a household projects that it's only a temporary economic impact, they could resort to borrowing. Credit card lending could increase. We saw the rise of buy now, pay later during the previous pandemic. Households have ways of being able to smooth out their consumption. The early evidence suggests, with consumer confidence at record lows, retail sales starting to soften, that households, the majority of households are in that bucket one. They are cutting back. They are trying to make ends meet by buying less. Obviously, that's going to have an effect on all types of businesses. The B2C businesses are likely to see a fall off in demand, and at the same time, the increase in costs. If, however, as we go through the next few months, if there is nothing left to cut back, then consumers will have to borrow in order to continue to smooth out that consumption.
Okay. I mean, I think this next question kind of builds quite nicely on from where we've just sort of the discussion points we just had there. So obviously, the Great Resignation is a phrase that I think we're all quite familiar with now. But rising living costs are driving workers to change jobs more frequently, take on more hours, and even attend work when they should be otherwise off sick, according to a recent survey by HR software provider CIPHR. I wanted to ask you, what do you believe the salary implications for businesses and employees are looking like in order to mitigate the cost of living crisis?
Fantastic question, Aaron, and it goes back to some of the earlier discussion that we've had already in terms of, as a business, as a finance professional within a business, you're being faced with a squeeze on both ends of your bottom line in terms of what's happening with your revenue and your costs. Revenues can be down because of the softening demand coming through from both businesses and potentially consumers. Wage costs have risen. Wage costs have risen the fastest in a generation. It's important to try and break through the data. At that macroeconomic level, I could actually tell a story as we sit here today that the UK economy on average had a real wage growth over the last year. And a lot of that is being flattered by bonuses. When you exclude bonuses and you get to what, as economists, we call regular pay takes into account inflation at 9%, like you mentioned. In that scenario, wages are actually falling by nearly 2%. Wages are going to continue to fall by up until minus 3%. Now, as we share those forecasts, consumers are also aware of those. You and I are also aware that it's costing us more to put petrol in our cars, maybe commute to work. The energy prices are going up. Prices of our weekly shop are going up. That means that we are going to go back, in many cases, to our employers. And we're seeing it in the public sector, especially with the movement in and the unionization impacting the railways, for example. We've all seen those strikes come through. We're now seeing further strikes planned by potentially the train drivers union. That's all pointing to an indication where people are coming back and asking for higher wage rises. So the implications for both individuals and companies is the labor market that we are in. And this is a really important point to, I guess, make, and also for us to maybe expand on. We are expecting a recession. We are expecting 2 quarters of negative growth over the next 18 months at some point. At the very same time, with those storm clouds gathering, with inflation at a 40-year high, if you look at the unemployment rate, I would argue it's at record lows. How is that possible? How do we square that circle? Or the effect of that is what's coming through. Because we have such a tight labor market, inflation is obviously being the root of inflation is to do with the cost of global oil prices and other things. But in the UK, particularly in the UK, that tight labor market, like you mentioned there, the ability, that fact that vacancies are outstripping the number of people unemployed means that this is very much an employees market. The employees have the power, the workers have the power. So we do still think that there is still further wage increases in the system. We still think that wages are going to increase in nominal terms at the very least. So in terms of salaries that are being paid out to workers, they are going to increase in nominal terms. I say nominal because if, for example, let's keep the maths easy, we see wages go up by another 10%, but inflation in this scenario goes up by another 13%, then actually in real terms, wages are still falling, but we are still expecting 10% or that number to increase from where we are today.
Interesting. So just my final question now, Mo. So obviously UK GDP has been reported to have dropped for 2 consecutive months. Stocks and sterling have slumped amid recessionary fears, and with the country's economic recovery in the wake of the pandemic contorted by sector and regional imbalances. So I just, in a desperate attempt to end our conversation on a more optimistic note, despite that backdrop, what does the road to recovery look like? And when and where will we begin to see some early rays of sunshine piercing through this otherwise pretty gloomy economic outlook?
I'll do my best to answer on some optimistic notes. The first thing I would say is the labour market, whilst it remains at record lows, and how do we scare that circle? We feel that actually there's quite a number of people who are hidden unemployed. Put that to one side. When you look at the actual labour market, that is a real ray of sunshine. What you can see there is the UK labour market, structurally speaking, is very flexible, is being able to take into its stride the economic impacts. Normally, all of us as businesses would be looking at the unemployment rate going up, increasing, and seeing a softening in demand for our products. Well, if unemployment remains low, and we do expect it to go up, but not as high as previous crises, well, then UK PLC, UK consumers, UK businesses can take a huge sigh of relief, because that's a real positive. People aren't losing all of their incomes. They're not going from having a wage and salary to not having a wage and salary. Yes, inflation is increasing and it is reducing the power of the pound in their pocket, but that pound is still there because they're still in a job. That's a real ray of sunshine. The other thing that I would mention and expand on is those excess savings. We've seen excess savings built up by about 200 billion during the pandemic. Whilst they have reduced, they still stand at about 150 billion. So again, if households were to take the behavioral choice to spend those savings rather than add to them, or rather than, should we say, cut back on other goods and services, that's a positive, because they've got that buffer there. They've not had that buffer before. So we'll be paying close attention to how savings actually evolve during the next 18 months or so. From a business perspective, we've also seen a lot of the implications coming through from various different budgets, the super tax deduction, etc., coming through. So if we were to see any other fiscal moves from the new chancellor or the new government, which we may have in place over the coming months, that's a positive. If we were to see another way of businesses being able to unlock their investment opportunities, that could also be a positive. So it's the storm clouds are there. The economic outlook for a recession is very much there. What we would say is we're hoping that the crisis is short and shallow. We don't expect the recession to be deep. That's our central case. Like I mentioned, there are many other cases for us to consider. But even then, that's where we can definitely have some optimism that whilst the crisis is just around the corner, we don't expect it to be long lasting.
Excellent. Thank you for helping us end this first episode on a light note, or at least as light as it can be, given the outlook. And also thank you very much for your time, Mohammed. I really appreciate it.
You're very welcome, and thank you.
Awesome, thank you. Sadly, obviously, this is all that we have time for, but really appreciate you sharing your insights with me and our subscribers today, Mo. And for those eager to watch more video content or simply looking to access information on the latest emerging trends impacting senior finance leaders, please visit the CFO online and subscribe to our YouTube channel. Thank you all for watching, and until next time, goodbye.